It's, in fact, March 28th, a Monday, in the year 2016. It's our opportunity to get together as a community here at Forex.Today. And what we're going to do today is go through the Commitment of Traders report. We're going to go through the calendar and look at event risks for the week. And remember, a risk can also be an opportunity. It could be a giant mistake if you have no plan, right? So we should probably take a look at that. And then if we have time left over, we'll do some technical analysis. But if we don't get to it, don't worry, because we'll do technical analysis tomorrow and the next day and the next day, the next day, and the next day. So without further ado, let's clean up the office and get to work, huh? Ba ba ba. Oh. Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, so please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Ni hao ma. My name is Wayne McDonell. I am the Chief FX Market Strategist for TradersWay.com, an ECN that enters your trade into the interbanking system. Yeah, you click a button, and we go, pow! It's out there super quick, much faster than most, very, very reasonable prices, and no drama. Right? How many people like drama when you pull the trigger? Even worse when you're trying to get out, right? Yeah, don't be a drama llama. Yeah, so anyways, check us out. Seriously, go to TradersWay.com, open up a demo, give us a try. Contact customer service, you'll love them. Anyways, we do these sessions every day, 7:30 in the morning, Monday through Friday here at Forex.Today. No, Monday through Thursday here at Forex.Today, and every Friday at FX Street, where I am Forex Speaker of the Year for 2016. Cool. Yeah, clap, clap, clap. Hey, why not? Why not? You got to celebrate when you have the opportunity, right? So thank you for your loyalty and making that happen. Boop. So there's something right in the world today. Don't know what it is. Yeah, so let's take a look what's happening here. Chinese industrial profits. Yeah, first rise after 7 straight declines. Good job, China. Right, so they're up 4.8% versus down 4.8% in late last year, huh? So hey, that's interesting. Is this one of the signs that we should start tiptoeing into commodities? Have commodities bottomed out if there's industrial profits? Or maybe China's just simply making profits now that commodities are so low, right? But we're always going to look for a possible bottom. Okay. What else going on? Okay, Nikkei up almost 1%. Australia closed. Korea flat. China up 0.5%. Hang Seng closed. Okay, cool. So fine. More bullish comments recently by Bullard. People watch him closely. He says April and June are live events for potentially more tightening. Okay, I doubt that. But I think, and let me kind of translate through, because there's no press conference in the April's meeting, as you probably know, and it would be redonkulous to change monetary policy, stay transparent like a modern central banker, and then have no opportunity to talk to the press. I guess they could just call a press conference, but all of that is highly unusual. Do we feel like there's such an emergency state of affairs that we have to call a specially designed press conference because we just have to jack up rates to, as soon as possible? No, that doesn't feel right, does it? So more likely, I think what he's setting the table for is to say, pay attention to April. We're going to give you some pretty obvious clues that we're going to jack up rates in June. And the reason he's giving you the heads up because is that if he makes you think at the April meeting that they're going to raise in June, then it's basically a raise in April, and the foreign exchange market could just price in the June raise in April. So it's just as good as doing it, right? But let me say it come from another angle here. At the last meeting, Janet basically cut out 2 rate hikes out of the language. Why suddenly do an emergency rate hike now if they just cut them out, cut 2 out of the language? Why would they just suddenly throw one now because it's so important that we have to get it in April with no press conference? See what I mean? So most likely it's a June-December scenario. If she says there's only going to be 2 this year, then it's June and it's December, right? I mean, that's it. There it is. Every 6 months, raise interest rates. Good, fine. So that's how I'm reading that. Remember, that could be completely wrong, but that's how I read it. Chinese beige book. Do you guys remember what the beige book is? This is where a central bank goes around their regional offices speaking to regional business leaders about how they feel and what they think about future business, and also gathering statistics of what's happening recently. CapEx, capital expenditures. Another way of looking at it is sort of like business investing. Hit a 5-year low in China. Whoa! Right? 33% of companies reduced their investments. Holy smokes, eh? But pointed to improving profits in Q1, which now we've seen, right? But they've been reducing staff. All right, so great. Not too many surprises there, but it's interesting. And as foreign exchange, experts, I think it's good when you sit down with your clients, guys, just throw in the Chinese beige book. Right? Just casually, like you're having a drink or having coffee or something like that, and you're like, oh man, yeah, I was just reading the Chinese beige book released by the People's Bank of China. And I was, even though, the jobs seem to be stabilizing, profits seem to be improving, but there's this huge opportunity with CapEx being, down, I think moving in the next few quarters that CapEx could come back to normal. What do you think? I think I want you trading my money because I don't know what that is and I don't want to spend my weekends reading about it. Yeah, that's what I thought, sir. Thank you. Right? I mean, right? At least to impress the girls, right? You see the 5-year low in Chinese at CapEx? They're like, wow, he's such a dreamboat. Yeah. That guy, man. Who was that? All right, European session. Hey, it was closed in Europe. Wah, wah, wah. Okay. But what are we looking for moving forward? We'll see a lot of this data and some more when we take a look at the calendar. But Yellen is speaking, I think it's tomorrow, at the New York Economics Club. Then there's obviously NFP on Friday. And we also want to look at inflation data coming out of Europe, which, I think is laughable, right? I don't think you're going to, but we want to see maybe an improvement in that data. And then the Tenkan survey. And we'll see lots of news out of Japan this week, in particular the Asian session coming up. And then for today, trade balance. Remember, the bigger the negative number, the better. But you know what? I was pondering this the other day, and yes, I do ponder such things. But I'm sitting there, like other people do yoga. I'm like, oh, think about global macroeconomics. What happens to this trade balance if you look at because most people look at the historic data going back decades, right? What happens now that the United States is a net exporter of oil? See, we used to be a net exporter of oil, and then we didn't have enough, so we started bringing lots of oil in from, let's say, the Middle East and other places, and we completely relied on them. And then now we're at this point where once again we're selling oil into the international market, a pretty significant amount. What happens to trade balance? That instead of buying oil from foreigners, we're selling oil to foreigners. Yeah. So I might have to, now that I just said that out, right, when I brought up the trade balance, I go to my immediate thought that I've had for 100 years, and I say, oh, well, a big negative number is a good number. And then I'm like, wait, that might actually be changing. So I might have to revisit this idea. And I mean, it may change a lot. It may change nothing. But I need to maybe at least change my language, right? But it used to be the bigger the negative number, the better, because Americans were so rich they can buy foreigner products from foreigners. If they were poor, they couldn't afford to buy anything, and then they wouldn't buy anything from foreigners, and this would become closer and closer to a zero instead of a giant negative. But anyways, be interesting to watch that. Personal income, personal spending. All of this is very important right now, because what are we concerned about? Jobs? No, we got that under control. What are we concerned about? Housing? No, we got that under control. What are we worried about? Inflation? Wait, we don't have inflation, but we've been spending like trillions of dollars trying to create it. Oh, well, what is inflation? What's good inflation? Well, that would be people with stable jobs that feel like they're going to have their job indefinitely. They're not worried about being fired next month, and that they've paid down their debts and they have disposable income now, and more importantly, they feel like the income will continue. It's not just a check they got today, like a tax refund, but ongoing income. So then now they feel like they can go out and spend. Once they start spending, so you want to see personal income going up, right? You want to see spending going up, and then you're going to see things like expenditures go up, and demand for products going up, and new orders going up, and same store sales going up, and eventually PPI goes up, CPI goes up, PCE goes up, GDP goes up, and we got a healthy economy. And if all that goes up too far, then interest rates start to rise, and the whole cycle theoretically should slow down over time, right? And if you understand all this basic stuff, let me explain how the world works. Ooh. If you can catch this cycle, let's say it's somewhere between 7 and 12 years, and so you got to watch the data. You go from a trough where we are now, and it rises up, and we have those boom years, and the stock market's going, and your idiot neighbor across the street buys a very, very, very expensive car, and you're like, that idiot has an expensive car? What the hell's he doing? Well, we're nearing the peak, right? And then you get an inverted yield curve, and you sell your entire stock market portfolio, and you move to bonds, and you'll be the only idiot in the world buying bonds. But that's what you want. And then in the assuming 3, 4, 5, 6, 7 year decline, That idiot loses his car. You know, the guy across the street loses his car, loses his house because he lost his job, so on and so forth. And the stock portfolio falls, and you're making a killing in the bond market. And you already cashed out at the top of the stock market, and you're just like killing it. And you're like, nice car, dude. I'll give you $50. And now you're driving his nice car around for pennies on the dollar. And you're like, I'm the smartest guy in my whole neighborhood, right? And your children obey you and respect you. Right? Your wife gets better looking, just boom, the whole world changes. And you say, man, Wayne really helped me out. I like that dude. So yeah, so that's how you put it in perspective. We're troughing. Unless you're 80 years old, you're going to see a peak again. It's just not now. Okay, and everyone else will be really, really confused. The most amazing part of my sort of education in the finance industry over the last, decade and some change is actually how unbelievably simple it is. And I don't know why it's so confusing to the people on TV, the experts. Okay, so I just explained how that works, right? Watch this go up. 7 years from now, we'll have an inverted yield curve, move from stocks to bonds, and you'll be fine. Okay, and then when that process hits bottom, buy everything for pennies on the dollar. Buy houses, buy cars, buy factories, buy companies, buy everything. Yeah, Miles. Okay, boom. Japanese job report coming out. Household spending in Japan coming out. Retail sales coming out. Okay. Now put this in the context of what I just said over here. What's the cycle that we're looking for? That you have a job and you feel comfortable your job will remain, and that you will earn income and the income will not go away anytime soon. So you feel very confident that what you have will at least stay there. And with that reliance on future income, you have a marginal propensity to spend. And so you'll want to see household spending going up. And because of that, you'll see retail sales going up, and eventually through the rest of the cycle, like PPI and CPI, eventually you're going to see inflation. Okay, that's what we're looking for. So jobless rate in Japan, 3.2%. That's fantastic. Okay, fantastic. Great. Overall household spending, negative 1.7% year over year. Well, that's good news because last year it was negative 3%. Okay, let's try to put this together. Jobless rate's good. Last year, negative 3. This year, negative 1.5, let's say. Let's just round them all out. So it's half as bad as it used to be. So that's good, right? So clearly the trend is up. So you can look at it from another point of view and say maybe somewhere it's doubled, but here it's have the negative. But maybe it's going in the right direction, right? And then you look at Japanese retail sales month over month, still basically negative 1% month over month. Let me get the annual on that. I must have cut it off. Let me get the annual one for you. Un momento, por favor. Okay, month over month, negative 1%. Retail year over year. Okay, this is it. Okay, they're expecting 1.5% versus 0. Okay, so that's good. And they're looking for, it's not here either, they're looking for about a 50% increase in department store sales. So there's some interesting things going on here. Consumer spending is better. Overall household spending is going from drastically negative to better. Jobs are stable, you know. So maybe some good news in there. Well, how about household spending, retail sales, and maybe a little bit of inflation kicks in the next 6 months? What happens to the Nikkei? Well, Miles says if you're Japanese, even if you don't have a job, you fake that you're going to work every day, right? Well, I've met Americans working at Japanese companies that said that everyone goes to work and then fakes that they're working. A buddy of mine actually got fired from a Japanese company here in the United States when he got out of college. It was one of his first jobs. There was like, I don't know, hundreds and hundreds of employees in this office, and not one of them was working. Not one of them. He's like, and this was a guy that likes to hustle. And he got to the point where he was just walking the hallways, like poking into people's offices, like, "Hey, do you have anything for me to do?" And he started, and then they realized this guy's going to ruin it. That people are going to find out somewhere that this whole office building was faking it. So they fired him because he was trying to get something done, and that they realized he was going to spoil it. So literally, people would come to work and sit there and work on things, making it look like they would be busy, like meetings. So I don't know where that fits in the full cycle. Hey, Miles, an American worker fired out from a Japanese company because he was trying to get something done. Yeah, exactly. That's why guys like that don't work for the government, huh? So, oh yeah. So if spending goes up and so household, let's say income, household spending, retail sales, right, and then eventually there should be some inflationary data down the road, right, because that lags a bit. What happens to the Nikkei? The Nikkei goes up. What happens to the Japanese yen? The Japanese yen loses value. Why? Because the Japanese investor, even retail investor, feels confident enough to invest their money overseas. And Japanese government bonds are likely to pay zero or even negative now, right, for a very long time. And that there would be a better opportunity maybe buy a bond in Australia to pay 2% to at least beat that little bit of inflation in Japan, at least a little bit, right? And so they'll start investing not only into the Japanese stock market, but maybe in foreign stock markets, foreign bond markets, so on and so forth. And so that has an inverse correlation. So if the Japanese stock market's going up, the value of the Japanese yen is going down. And therefore, if we're watching this economic data, we will know whether we want to buy the Australian Japanese yen currency pair, which means you're buying the Aussie along with the Japanese, and you're selling the yen along with the Japanese. All right, so like you might not have enough money to move the Aussie yen up, but you and the entire population of Japan could probably have a positive impact. Well, Miles says no one invests in the Nikkei from abroad. Well, of course they do, right? So it has to do with inflows versus outflows, right? The net flow. Okay. Something right in the world today. So let's start with the commitment of traders report. Just a brief on this. It's a government report. It was released Friday after trading closed. And I need to double check that the holiday didn't mess this up. Was it delayed? It looks like it was delayed, huh? All right, so we're not going to cover it today. But again, just a brief what it is. It's a report by the government, and what they do is they make large institutional investors that trade in the futures market report their large positions. So that therefore we know if the market's vulnerable to a big crash because everyone's in the same trade. And then they break it down and they say, look, tell us if you're a hedger. If you're a bona fide hedger and you're in the market simply to hedge your exposure, then we'll tax you differently. Okay, so fine. So a bona fide hedger tells the government, we're heavy in the market, but we might be going in the opposite, right? Or we're doing it for a reason, not to profit. Great. And then you have everyone else that's a large institutional investor that's in the market, but they're not a hedger, so they're in it to make money. Great. But that won't be total volume, right? That won't be total volume. So now you take total volume reported, and then you have the volume that exists that wasn't reported. Now you know that they were not large institutional, trades. They were small retail trades. So now just by looking at the data, you know who's in the market to hedge, who's in the market to make money, and and then the dumb money, everybody else. And that's why we look at this, so we can see changes in trend and stuff like that. But because of Good Friday, looks like we don't have new data, so we won't look at this week. Boop, 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 boop. Boom, 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 boom. Dun, dun. Well, Miles, there's smart institutional investors that have quantitative analysts. They have PhDs. They have MBAs. They have lots and lots of money to spend on resources and databases and bringing consultants in and having dinner with Ben Bernanke. And then there's you, right? Yeah, there you go. Yeah, 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 yeah. There's a saying in poker, right? When you walk in, and everyone's standing around before the game starts. You should be looking around, trying to figure out who the sucker is. And if you can't figure it out, it's you. Yeah. But let me tell you, the big institutional investors um, are shockingly not brilliant. So it's just smart money versus dumb money is just the old saying. But um, I don't know. One of the largest investors in the United States, and I think he is the largest investor in New Jersey. So someone that manages billions and billions and tens of billions, hundreds of billions of dollars kind of stuff. He talks like a street thug. He's been on CNBC several times, and he swears. He just can't help it. So and that's him on his best behavior. When you're in the office with him, he's just street thug. And I saw this guy the other day. I forget who it was, but he was in charge of some department at Goldman Sachs. This guy was a big dude, like athletic, military kind of, but wide and big and strong. And he just looked like he would be the guy that would come into your office and you've worked 90 hours that week and he would yell at you that you're not doing enough and you would probably work harder. and you're like, now I know why Goldman Sachs makes so much money. Because if you work for Goldman Sachs and you're not making an amazing amount of money for the firm, this guy comes in and breaks your legs. And you're like, wow, I get it now. Mediocrity is not acceptable at Goldman Sachs. Oh, yeah, no, but this guy looks like, yeah, tough guy for sure. Someone that would freak out and yell at you at the top of his voice, cursing you and screaming at you in front of everybody. It wouldn't matter. Just look like that guy gets his money. So it's not necessarily drill instructor, but it's, I don't know, mafia gambling collector, right? You lose a bunch of money on the Super Bowl. This guy shows up to collect. He's showing up for Goldman Sachs. F you, where's my money? Oh, well, the market's been down. It's been really tough. F you, where's my money? Yeah, no, but I'm telling you, you're like, holy smokes. Goldman Sachs is going to make money. I saw that guy. He's going to make sure that you make money for Goldman Sachs. Yeah. So, anyways, let's see. So on this, I don't have the Japanese news coming up. So let's put that. So trade the Asian session today. Okay, this will be better. Let's do it this way. Boop. Come on, man. Okay. Trade the Asian session today. It's not even on this one, is it? Household spending, retail sales. Okay, fine. Then we have the PCE, personal spending, trade balance and stuff today, which is in about 15 minutes. Okay, fine. And I have a database. Maybe I should. I haven't opened it up in a long time. I don't even know if it works anymore. Wait, I might not even have it on this PC. I don't even have it on this PC. I should probably install that. Yeah, it's not on this PC. Too old. All right. So, anyways, sorry for that. So yeah, Trade Asia, great. We know we got the news coming up in a few minutes. Great. Good. Yeah. And tomorrow, what do we got? Money supply, nah, wouldn't pay too much attention to that. Raw material price, nah, wouldn't pay. Consumer confidence, I don't like consumer confidence. Again, the whole story about consumer confidence that I always think about was I was reading about something. This was a million years ago, this story, but it had to do with how Sony decided to make the Walkman yellow. And they were doing focus groups. So this was, I don't know, 1981 or something, right? And they did all these focus groups. Look, you could listen to a cassette tape and put headphones on your ears and walk around. And so they played with it, and they're watching the focus group people use it, and okay, they'd put the tape in, but they would drop it, and the tape would come out. So it's going to need a little clasp, which they did, and it should be a little bit waterproof, which they made, and all these things are really neat, and they really liked it. And one of the questions they asked, what color should we make the Walkman? And they said black, 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 black. Everyone's saying black, 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 black. Great. Focus group's over, right? And the leader comes to the front of the room and says, okay, well, thank you very much. And, well, we have a parting gift for you guys. In the hallway, on your way out, please grab one box, right? Grab one Sony Walkman. You can have one for free. Thank you for participating in our survey. And they're like, oh, yeah, that's awesome. They go in the lobby, and there's like 8 different colors. Which one do they grab? Yellow. They grabbed the yellow ones. And that's how the Sony Walkman became yellow. But they said on the survey black. Confidence, I just don't like surveys like, how do you feel? How do you feel about, I don't care. First of all, no, I don't care about people's opinions. I care about your opinion, of course. But generally, I don't care what people think about. But what I do care about is whether they go out and spend money, and I see the data, and they actually put the money in the market. I'm like, okay, that's great. Your opinion about whether you want to do it or whether you think people should do it, couldn't care less. Right? So that's why con, I don't like it. Yellen, okay, she manages the global economy. What she says could be important. People are watching this because the dot plot is in jeopardy. The April meeting has been called a live meeting. We're all expecting June. She's just backtracked over her December meeting and just effectively cut out two interest rate hikes this year, changing it from 4 to 2. So this gives Grandma Yellen an opportunity here to maybe, change again, try to influence what the market thinks she said, or a new opportunity to re-say maybe better what she meant before, but maybe didn't say it well enough. But we might learn something here. Okay, she could prepare us for April, which is the launching pad for June. Pay attention. Okay, RBA is going to give her a report. Pay attention. Okay, your foreign currency trader. Okay, if the RBA puts something out, read it. Okay, is it going to hurt you? No. Okay, so preliminary CPI data, and there's all kinds of versions of consumer level inflation coming out of the Eurozone. Lots and lots and lots of it. Pay attention throughout the week. And I wouldn't trade them individually, but I'd look at it and then aggregate it and just ask the basic question maybe at the end of the week. Is inflation improving in Europe? Yes or no? Okay. So maybe look at the Eurozone data, PMI, CPI, that kind of stuff. German, maybe a little bit of French. How's the UK doing? Just aggregate it, if you will, and then form an opinion. More importantly, right? Form an opinion. Have an opinion. Discuss it with your children. Okay, Wednesday, another dumb prediction. ADP, another dumb prediction. ADP is a payroll processing company for small and medium-sized businesses. So instead of having a human resource department that do things like your benefits and actually issuing paychecks and holding back taxes and paying the government and all that kind of stuff, that's a real pain in the buttocks, as they say in Paris, right? The pain in the buttocks. So you can just hire a company to do all that, and that would be ADP, the largest one. And so the ADP number is interesting because it's, well, how many paychecks did they print this month? And I call it another dumb prediction because obviously ADP is not what that stands for. But there used to be this idea that if ADP was good, NFP would be good on Friday because it always comes out the Wednesday before the first Friday, right? Or the Wednesday before NFP. Over the last 6 years, that has been true because monetary policy has been creating the the number in NFP and ADP. So we went from, you know, 10 or 11 or 12 or 20%, whatever you want to use as your unemployment number, in the United States. And then the central bank came in and manipulated the market, increasing money supply, and, you know, basically help create jobs by making money free. Okay, great. So obviously, if that's happening, the trend is up. No matter what happens, it's going to be up. Historically, excuse me, before the recent financial crisis of 2008, if you looked at, let's say, the 10 years prior, or 20 years prior, or 30 years prior, I think we looked at 20 years prior, there was no correlation. There was no positive correlation, no negative correlation. There was just none. It was basically a random idea. So if ADP was up, you know, was up 3%, NFP could be down 2%, and you're like, well, then there's an inverse correlation. So the next time it comes out good, then you sell NFP, and then NFP comes up. And so that previous set of data that we analyzed, right, showed that there was no correlation whatsoever. Yet the people on TV would talk about, oh, the good ADP means this. Oh, the bad ADP means that. And and if you were smart money, right? I'm not saying who, but if you were smart money, you knew that there was no correlation whatsoever, and what they were talking about was fool's gold. Okay? It just didn't matter, basically, right, Miles, to say it that way? But now, Miles, I would say the correlation is a positive correlation. I haven't seen a meaningful divergence, let's say, like a really bad ADP but a really good NFP. No, they've been pretty much correlated, but I think it's because it's not a free market trend. This is a government manipulated trend in the sense that they helped create the jobs. Okay? And it's by design. But 5 years from now, when we get Europe back on board, and China and Asia's back on board, and commodity exporting nations are back on board, and yeah, and interest rates are much more normalized versus negative, okay, yeah, then we're going to have more ups and downs and ups and downs, and because we'll basically have a normal economy is ups and downs, not just 45 degrees up or 45 degrees down, right? Because everything's kind of normal, and you'll have an off normal and a good month, and maybe an off normal disappointing, but you'd be within 2 standard deviations and inside the bands, if you will, and it'd be normal, and you would see situations where ADP is a little down, NFP is a little up. And what would that mean? Well, small and medium-sized businesses have laid people off. You could go to the Challenger Christmas report and see if it's mass layoffs, right? Or on the NFP side, you may see that there's government hiring. So let's say ADP could be flat, but NFP could be up because states and the federal government have decided to hire a lot of employees. Maybe the economy is doing good and they feel like they need to spend money on everything. They need the federal department of, red, blue, and yellow flowers. And they're going to hire a whole bunch of people to take care of those colored flowers. Whatever. And that happens, right? Well, it happens, Miles. So, but more importantly, as economists, we know what it means. Versus just like, oh, did you see this? Did you see that? Again, the talking heads on TV, most of them are fabulously stupid. Well, I shouldn't say that. You should think, all right? You should think for yourself. which is a much better process, right? So is there a divergence in ADP, NFP? You say, oh, well, that's interesting because over the last 5, 6, 7 years that they've been correlated. Why are we diverging? Take a look at the numbers. Which one was disappointing? ADP. Okay, that's small and medium-sized businesses. Okay, why are they laying off? Or are they not laying off? So you look at the Challenger report. Oh, I don't see layoffs there. So what's going on with NFP? Why was NFP so much better than ADP? Where was the hiring? Where was the layoffs? And they break it all down. You're like, oh, well, look at all the government hiring. So we did this back in the financial crisis period where we saw small, medium, and even large businesses laying people off, and then it stabilized, right? And they started to hire, and then what happened was the next fiscal year, the governments had less budget, but remember, a government budget's a year ahead and will spend the money because they're right. And then suddenly the new budget came out for the next fiscal year, and then as the businesses were improving, NFP should have improved, but it didn't. What happened? It stayed down. Why? Local cities, local counties, states, and the federal government started laying off government employees. And it held things down. The government was getting smaller, small and medium-sized businesses were trying to improve, and there was a big drag and slack and all this stuff going on. So you can look at the numbers and interpret what it means, right? All right, so blah, 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 ADP, business conference, great. German retail sales, okay, that'll be important. Carney's going to speak, yeah, okay. It's okay, that's what he's going to say. So yeah, what's he going to say about the state of the Union, of the Kingdom, the United Kingdom? I wonder how long they're going to stay a monarchy, huh? Yeah, you think, Miles? Forever? All right. So, like one of the things we were discussing at Harvard the other day about in the geopolitics of the, let's say, the GCC region, is the different forms of monarchies that they have in the Gulf states. Right? You have federal monarchies like the UAE. You have constitutional monarchies like you have in Qatar. You have absolute monarchies like you have in Saudi Arabia, and you're like, oh yeah, it's interesting. All right. So, anyways, I diverge. Okay, GDP out of the UK. Yeah, that's going to be important too, right? So you can see March 31st going to be a big day in the European session, right? Time to pay attention, right? And along with that, the Eurozone CPI. So like I said, keep an eye on aggregate CPI, and then which you'd get through this Eurozone version. But then you could also do it just by watching, like, how's France doing, how's Germany doing, how's Liechtenstein doing, and just put it together in your own brain. Have something to talk about. Okay, and what are you going to talk about with your billionaire investors? What are you going to slip into the conversation? Do you guys remember it, or is it already gone? I was just recently reading ... Wink, wink, nudge, nudge. Chinese beige book. Yeah, thank you. Yeah. See? Okay, PCE. Was it? Wow. Came out. My clock is 1 minute off. Interesting. Or this is early. Personal income, 0.2%. Okay, better than expected. Personal spending, 0.2% better than expected. Very nice. PCE, year over year as expected, month over month as expected. Core PCE, which is interesting. Almost as expected, just a slight below. 0.1 versus 0.2 month over month. 1.7 annually versus 1.8 expected, with the deflator as expected. Trade balance, basically negative 63 billion. I'd say based on my old thought process, better than expected. And obviously we're not exporting oil at this price. So, okay, it's telling me that Americans are spending, and maybe not much, but they are spending, and that you're going to see half decent retail sales and other types of data in the near future. Okay, good. So anyways, that's all live. That just came out. Oh yeah, Canadian GDP. Okay. Yep. Right. GDP out of the UK. What an amazing day. Okay. So don't take the 31st off. Make sure you're going to work that day. And then, what do you think? Continuing claims at Chicago PMI? Nah. So Thursday is going to be a booming day. Booming. And then later that day, even though it says April 1st here, for me it's still Thursday night. It's Friday morning for others. And you're going to get big industrial numbers out of Japan. And obviously good would be good, bad would be bad. Bad meaning if all these numbers are disappointing, the Japanese yen gets strong. Okay? Chinese PMI, yeah, it could be important. What do you think? Okay. To get back over the 50 number would mean expansion out of their economy. 49 is bad. 48 is bad. Okay? So it'd be interesting to see when we get over 50 and how exciting that will be. Okay? More PMI out of Spain and the UK and stuff. Fine. But at some point, we're going to say, okay, we're past the Chinese data. All we care about now is non-farm payrolls. Okay. And it's interesting because I haven't figured it out how the government makes their decisions, but sometimes when non-farm payrolls falls on, it's usually the first Friday of the month, right? So when the first Friday of the month falls on the first day of the month, sometimes they move non-farm payrolls to the second Friday. But sometimes they don't. Sometimes they do. Sometimes they don't. Makes it very fun to predict, right? So anyways, looks like, according to this data, they're going to do non-farm payrolls this Friday. Cool. So we're going to have a great trading week. There's lots of great data there. Some really nice Asian sessions to trade. The dollar, is going to have opportunities to zip up and down. I don't know how much inflation data that will be, let's say, interesting out of the Eurozone, but you should watch for it to be interesting. Are the negative interest rates working? Is quantitative easing working? Should more be done? These are all big academic kind of questions. Ultimately, I think we need a 5-year cycle, and we're basically halfway through year one. No, has it been half? No, I bet you it's pretty close to a year now. When did quantitative easing start out of Euro? So maybe it's been 1 year. So we got 4 years to go, right? So, I wouldn't expect much out of the data quite yet. Or maybe it took the United States 5 years because there was nothing else in the world. So maybe if the Eurozone improves more quickly than that, let's say it's a 3-year cycle instead of a 5-year cycle, maybe perhaps it's because there is a healthy economy in the world, and that would be the United States. So I love you, babe, but I got to jump. Peace on earth. May the pips be with you. May your profits be above average. And I will be here tomorrow and the next day and the next day and the next day because I love you. You're my sweet baby, and I want the best for you. Take care of yourself. You hear?